Welcome to Cascade Conversations. Join the team at Cascade Partners and their network of trusted advisors as they work to demystify details, terminology, and strategies in the world of acquisitions, divestitures, and financings.
Thanks, Mike, for joining us. So we have Michael Romaya here, who leads the corporate finance practice at Varnum Law Firm. Thanks for joining. I'm Arjun Murthy. I'm a director at Cascade Partners in the investment banking group. So, Mike, today we want to talk about some financings and considerations for middle market business owners and kind of your perspective on the legal front. So hopefully we'll answer some interesting questions that some people have asked us over the last couple of years or so. But, there's been a lot of interesting things happening in the world as of late. We've had the pandemic, a lot of supply chain issues, but also just a great market. Have you seen, any type of tightening or any type of restrictions given some of the global issues happening, or, have things remained pretty robust from your perspective?
Well, thank you for having me. And from what I've seen, things have remained robust. I mean, the markets remain strong. There's a bunch of lenders out there in various different categories of lenders that are looking to deploy capital and really be a growth partner for companies doing acquisitions or to finance recapitalizations or LBOs. So despite the things that have gone on over the years with respect to COVID and now the war, the markets here, at least in the middle market, definitely have remained strong and sort of remained borrower friendly.
And, when we're thinking about some of these agreements that the borrowers are looking at, because I know you represent both lenders as well as borrowers, is that correct?
Correct, yeah. Our group, we represent lenders, a lot of regional banks, non-traditional lenders, and a lot of borrowers, across the various spectrums from ABL-based facilities, cash flow-based facilities, as well as real estate and construction financing.
So it gives you a pretty good perspective, kind of how both parties across the table are thinking here, kind of what these agreements really entail. So from a borrower's perspective, what are some things that they can proactively do to prepare if they want to undertake a growth financing, acquisition financing, et cetera, that can make things go a bit more smoother?
Yeah. Well, one of the first things that they should do is make sure their house is in order, make sure there are governing documents, other material contracts like leases accurately reflect the relationships that are currently in place that will help streamline the process. And you also want to do a lot of your financial modeling with your advisors. If you're a financial buyer and you expect to do a lot of other add-on acquisitions, you really want to spend the time making sure you model out the right projections and as best you can. And then also make sure your credit agreements reflect that, making sure your financial covenants have the right ramp up period, have the right add backs, because you really want to avoid defaulting on covenants out the gate, because that can send the wrong message to the lending group. So more time spent on that in the front end is well worth it as the relationship goes on with your lenders.
So it sounds like that was a little bit of an indirect plug for having Cascade involved as well as Varnum. So having a good team of advisors ahead of time. So ideally, when we're thinking about it from the legal context, when would be the ideal time frame to bring someone like you in from a borrower's perspective?
I would say we want to start, even before you start gathering your term sheets and going to market, if we can, get in there maybe a few weeks or a month ahead of time to review your corporate documents, again, your material contracts, and just spend some time getting an understanding of what you're looking to get out of the financing, as well as we can, if there are any errors or things that need to be fixed in those documents, we can make the corrective changes. We don't need too long of a time to get that done, but a few weeks up to a month is really is advantageous, because if you start trying to address those concerns during the process, frankly, it just becomes more expensive and can distract from the overall timeline of getting the deal closed.
No, that makes sense. Oftentimes we see, and we're guilty of it too, people trying to bring us in at the last minute, and you're kind of playing a little reactive basketball there. So we try to not do that as much, but I know you still are able to have success in those situations.
Yeah.
There's a lot of different types of lenders out there right now in the universe, ranging from traditional large banks and institutions, and then other types of private credit funds, business development funds, unitranche players, SPACs. What are you seeing in the middle market, and how do structures vary by different types of lenders?
Yeah. So, you have your traditional bank lenders that are going to be more relationship driven. They're going to have tighter leverage constraints and maybe a little bit tighter of a box to fit in. But you're generally going to get, as long as you fit in that box, you're going to get some more favorable terms than you'll see from the non-traditional lenders. Obviously, the non-traditional lenders are going to have a higher cost of capital. A lot of times there can be equity kickers or other things that are built into the deals to making sure that they get their certain returns that they're expecting. And a lot of times, they work together depending on what the snapshot is of the business. You'll have a senior bank relationship, and then you'll have a mezz relationship sort of in a subordinate position. And you really do want to make sure that your senior bank and your mezz lender have a good relationship. A lot of times they've worked on deals together in the past. So I think it's very beneficial if you do have that structure to making sure your senior and mezz lenders, it'd be nice if they've done deals together, but at least are on the same page as where the growth is going to be, and you feel like they're going to have a good working relationship.
And so if you do have kind of that bifurcated structure with maybe a traditional lender and some type of mezz or unitranche player behind them, what are some considerations from a documentation standpoint? Intercreditor agreement, I'm sure, is something that comes to play. Where does someone like you kind of sit in terms of negotiating that, or is that really left to the two separate parties?
Depending on what side that we're on. Obviously the intercreditor, the majority of that negotiation is taken on between the two lenders with, some input and comments from the borrower side. But that's really the document that's going to govern the relationship and how things are going to occur between the various, the 1L sort of versus the 2L lender. And then they'll have, in a syndicated deal on the 1L side, you're going to have the credit agreement. And you also want to make sure the participants, if you do have a syndicated deal, are people that the borrower feels comfortable with, mainly the agent feels comfortable with, and they've done deals with them, because you want to have friendly lenders in the deal that all sort of see the company and the vision the same way. So a lot of times the agent bank is going to have various relationships and ideas to who to bring to the table for your bank group. And a lot of time, based on what the industry is, they'll try and find lenders that have experience in those markets. Like if you're an agricultural company, you want to have some lenders that have some of that strong ag experience. Because what you don't want to have is, in the bank group, is someone that gets uncomfortable or is in unfamiliar territory with the ups and downs that might happen in your industry.
No, that makes sense. Having someone with experience and kind of understands it, can kind of get through some of those intricacies of each business. Definitely would be the path of least resistance, you'd think.
Yeah.
But oftentimes it may not be, such as Cascade, who's a generalist, where sometimes we can add value regardless.
Correct.
Going back to the diligence front, quality of earnings is a big subject that we see, on the sell side and buy side from an M&A perspective. But on the financing side, are you seeing lenders typically require quality of earnings as part of diligence, or are there certain times in which it's not necessarily needed?
Yeah, it's very common, especially on the larger transactions. If you're on a single bank middle market type deal, no, you don't need them. But as you get into like the various bank group type structures, or you have some component of subordinated financing, you do see them, and they are common. But you don't see them commonly on a one bank sort of middle market transaction.
Got it. No, interesting. And then thinking through covenants, we've seen a lot of aggressive structures out there from all different types of lenders, and just given the rise and emergence of different types of lenders, things have become competitive. So have you seen any of that change as of late? We've seen the Fed increase rates. We're seeing a couple more coming down the pipe here. Or have covenants pretty much stayed aggressive, and thinking about the traditional 2 or 3 from a financial standpoint? Or how have those changed?
I've seen them sort of remain consistent with some sort of total leverage ratio, senior leverage ratio, fixed charge coverage ratio, or debt service. I think people have sort of been expecting the rate increases over the years, and now they're coming to fruition. So as the various progressions happen, we'll see if the credit agreements start tightening up or what considerations those bring. But so far, it's been the same sort of traditional covenant reporting package that you've seen. As you get into sort of non-traditional bank financing, you have sort of board observer rights, and you'll have various set of potential warrants and other options that are that come into play into the documents. But from the senior position, the general affirmative and negative covenants, they've remained consistent so far.
Yeah, that makes sense. I think regardless of bringing on a partner, there's going to be some sort of increased reporting requirements, probably that a lot of standalone businesses haven't been used to doing previously, but it can also be a good thing because it helps institutionalize the business as well.
That's right.
Thinking through the remainder of 2022, any helpful predictions that people are crystal balls that you have?
I think things hopefully remain strong. I mean, so far deals, there seems to be a lot of capital available throughout the market, and we continue to see a lot of deal flow and a lot of activity. We continue to see the growth in the financial buyers. So I predict that's going to continue. And I think from the lending side, the banks are ready, and as well as the non-traditional lenders, to sort of support that growth. And there's a big push to sort of partner up with the right management team and the right growth team to really see some of these returns that they're looking for, and really betting on the right management team that has a plan and can a good prediction of where they can pick up value, and they're willing to support that.
Well, great. Appreciate those helpful insights, and this was a great conversation. Thank you.
No, thank you for having me. Thank you.
Absolutely.